In January of the year 2000, two neighbors on the same street in Columbus, Ohio, both retired on the same day. Gary was 62. He had worked 35 years at a manufacturing company. Careful with his money his whole life, he had $1 million saved. Dennis lived 3 houses down, same age, also $1 million, also planned to withdraw $40,000 a year, the classic 4% rule, enough to cover the mortgage, the groceries, and a little travel. Gary put his entire retirement savings into an S&P 500 index fund, low fees, simple, diversified across 500 companies. His financial advisor called it the smart, easy choice. Dennis split his money differently. Dividend quality stocks, bonds, a cash buffer for the first couple of years of living expenses. For the first year, Gary looked smarter. The market was still climbing. His balance was growing. Dennis seemed overly cautious, maybe even a little old-fashioned. Then the dot-com crash hit. By 2009, Gary had $455,000 left. He'd been pulling $40,000 out every single year while the market was falling underneath him, and that combination is nearly impossible to recover from. He was 71 years old. His retirement savings had been cut in half. Dennis, withdrawing that same $40,000 every year from the exact same starting amount, by 2024, Dennis had $2.77 million. Same starting amount, same withdrawal rate, same economy, entirely different outcome. The only difference was what was inside the portfolio and the specific way a concentrated market crash hit someone who was already pulling money out. Today, I'm going to show you exactly why that same risk is sitting inside your S&P 500 fund right now, why the concentration is actually worse today than it was in the year 2000, and what the income portfolio built for the red zone actually looks like in plain numbers you can act on. The part most people miss, the solution is probably already sitting in your portfolio. You just don't fully understand why it works. And once you do, you'll never look at your index fund the same way again. Quick note, I'm not a financial advisor or a government employee. Everything in this video is for educational purposes only. For your specific situation, always work with a qualified professional, the number you're not seeing. Here's the number you need to know. 33.3%. That is how much of the S&P 500 currently sits in just 7 companies: Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. The Magnificent Seven. 1/3 of every dollar you put into your index fund flows directly to those 7 names, whether you chose them or not. When you include the full top 10 holdings, it reaches 40.7% of the entire index. That is the highest concentration in the history of the modern market. Here's the context that makes that number hit harder. During the dot-com bubble, the last time investors worried about a technology-driven crash, the top 10 companies made up about 27% of the index at their peak. We are past that now, by a significant margin. Here's the myth. The S&P 500 gives you diversification across 500 companies. Here's the truth. It gives you a very heavy bet on 7 companies, with 493 others filling in the rest. And here's what makes this especially uncomfortable. These 7 stocks don't just dominate the index by size, they dominate it by valuation. The Magnificent Seven trade at an average forward price-to-earnings ratio of about 31 times earnings. The other 493 companies in the same index, around 20 times. You are most heavily weighted toward the most expensive part of the market, the companies with the least room for their price to grow before it becomes very hard to justify. Now, for someone in the accumulation phase, 35 or 45 years old with decades of contributions ahead, this may be a risk they can absorb. A big correction becomes a buying opportunity. Time is on their side. But if you are within 5 years of retirement or already in it, this concentration works against you in a very specific, very measurable way. And the mechanism has a name: the retirement red zone. Researchers who study retirement income call the period from 5 years before retirement through 5 years after retirement the red zone. It is the most financially dangerous stretch of your life, not because markets are necessarily worse during that time, but because a loss behaves completely differently when you are pulling money out, not putting it in. Here's the math. You have $1 million at age 62. You're withdrawing 4% a year, $40,000 to cover your living expenses. That is the standard rule of thumb. It's worked for most 30-year retirements historically. Now, imagine the Magnificent Seven drop 50%. In 2022, they dropped 41%. A 50% decline in a concentrated technology-heavy group is not a stretch. It happened during the dot-com bust. If the Magnificent Seven fall 50%, your S&P 500 fund loses roughly 17% just from those 7 stocks alone, before the other 493 companies react at all. Factor in a typical sympathy decline across the rest of the index, and a realistic total drawdown puts your $1 million portfolio somewhere around $730,000. You are still withdrawing $40,000 a year, but now you're pulling it from $730,000. That's not 4% anymore, that's 5.5%. A 5.5% withdrawal rate from a portfolio that just took a major hit historically does not survive a 30-year retirement. The math works against you. Every year you withdraw from a depleted base, you leave less behind to recover. And here's the part that makes this so painful. You don't have to make a single mistake. No panic selling, no bad trade, no reckless decision. You just kept following the plan, and the plan couldn't account for the timing of the crash. That's what happened to Gary, not in one dramatic moment, quietly, steadily, year after year of pulling income from a portfolio that never had enough runway to recover, because the crash came right at the start. Most people reach for 2 solutions when they hear this. Option 1, hire an active manager to navigate the concentration. Option 2, stay the course and trust that time heals everything. Here's what the data actually says about both. Active managers underperform passive benchmarks more than 80% of the time over a 10-year period, and riding out a major drawdown while making annual withdrawals is not a strategy, it's a gamble on timing. Time heals accumulation portfolios. It does not always heal withdrawal portfolios. But there's a third option, and it's the one most finance channels completely overlook, because the answer isn't a complex hedge or an expensive product. It's structural, and it may already be in your portfolio right now. Before I show you exactly how this works, drop a comment right now. Are you in the red zone within 5 years before or after retirement, or are you still in the accumulation phase? I read every single comment, and your answer helps me know exactly what to cover next. The structural hedge you didn't know you had. Let's talk about SCHD, the Schwab US Dividend Equity ETF, and its close relatives, VYM, DVY, and HDV. Here is something most people who own these funds don't fully appreciate. They hold 0 Magnificent Seven stocks, 0 Apple, 0 Microsoft, 0 Nvidia, 0 Amazon, 0 Tesla, 0 Meta, 0 Google. Not because of a tactical bet against technology, not because a fund manager decided to underweight the biggest names in the market, but because of the mathematical structure of how these funds are built. SCHD requires a company to have paid dividends for at least 10 consecutive years. It screens for yield above the market average. It looks at cash flow, return on equity, and dividend growth consistency. Apple yields 0.5%. Nvidia yields 0.03%. Amazon and Tesla pay no dividend at all. Meta and Google only recently started paying tiny dividends, not nearly enough to qualify. None of them pass the screen. None of them get in. The concentration risk that lives inside the S&P 500 is filtered out, not by opinion, but by methodology. The fund is doing it automatically every single day. And here is what that looks like in a real crash. From August 2000 through September 2002, the heart of the dot-com bust, the broad market lost 44%. The Dow Jones U.S. Dividend 100 Index, the index SCHD tracks today, gained 17% over that same period. A 61 percentage point spread, not because dividend investors got lucky, because the companies paying consistent dividends were valued on fundamentals, earnings, cash flow, and actual business performance, not speculation. In 2022, when the Magnificent Seven fell 41% and dragged the S&P 500 down nearly 25%, SCHD fell only 15.7%. In early 2026, while the S&P 500 has been roughly flat, SCHD is up approximately 11 to 15%. The methodology is working exactly as designed. SCHD currently trades at roughly 17 to 19 times earnings, compared to 27 to 28 times for the cap-weighted S&P 500, and it yields around 3.3 to 3.5%. You are collecting more income from a less concentrated portfolio at a lower valuation. That is the structural advantage in plain numbers. But SCHD alone is not a complete retirement income strategy. There are two more layers that complete the picture, and one of them involves a shift in the bond market that has permanently changed the math for retirees over 55. The income portfolio built for the red zone. Here is what the retirement income portfolio built for the red zone actually looks like. 4 layers, each one serving a specific purpose. Layer 1 is your cash buffer, 1 to 2 years of living expenses in a money market or high-yield savings account, currently paying around 4 to 4.5%. This layer exists for one reason. When the market drops, you pull from here, not from your stocks. You don't sell SCHD during a correction, you pull from cash, give the portfolio room to recover, and avoid locking in any losses. This is the buffer that makes staying invested emotionally possible. Layer 2 is your bond income, and this is where most retirees over 55 are still operating on outdated math. In 2020, the 10-year Treasury bond yielded 0.52%. Bonds were nearly useless as income tools. That's the main reason so many investors went 100% equity. There was no real alternative. Today, the 10-year Treasury yields 4.37%. TIPS, Treasury inflation-protected securities, are yielding about 2.15% above inflation in real terms. A $300,000 bond allocation at 4% generates over $12,000 a year in income. That is money you do not have to pull from equities. And here is the number that should change how you think about this. Vanguard currently projects that bonds will return between 4.3 and 5.3% annually over the next decade. Their projection for U.S. stocks? Between 3.9 and 5.9%. For the first time in 15 years, the boring part of the portfolio is actually competitive with the exciting part. Layer 3 is your dividend equity income, SCHD, VYM, and if you want income with international diversification built in, VYMI, the Vanguard International High Dividend Yield ETF, which currently yields over 4% at just 13.9 times earnings. That is more income at less than half the valuation of the cap-weighted S&P 500. And Vanguard projects international equities will return between 6.9 and 8.9% annually over the next decade, higher than their U.S. projection. The international valuation gap is real, it's large, and dividend-focused international funds let you capture it while still getting paid to wait. Layer 4 is your long-term growth layer. Equal weight exposure through RSP, the Invesco Equal Weight S&P 500, which currently trades at nearly a 30% valuation discount to the cap-weighted version, and small cap value through funds like AVU. These positions are structurally underweight in the Magnificent Seven. They serve as your long-term counterweight to concentration risk without abandoning equities entirely. This is not a complicated portfolio, it's a layered one, designed for income, stability, and the specific reality of 2026, where U.S. concentration is at a historic high, bonds finally yield real income again, and international markets are the cheapest they've been relative to the U.S. in decades. Gary didn't have access to this framework in 2000. You have it right now. The S&P 500 doesn't pay you to be concentrated. Dividend investing does. If someone you know is heading into retirement or already there with their full savings in an S&P 500 index fund, share this video with them right now. This conversation could make a real difference in the decade ahead. And drop a comment below. Which layer of this income portfolio are you building right now? Cash buffer, bond layer, dividend equity core, or are you still working out your overall allocation? I read every single comment. If you're building retirement income and want to stay ahead of concentration risk, dividend strategy, and changes like this, subscribe to Dividend Hustle. I cover everything that protects your income in retirement.